Hey everyone, welcome to the FIN317 main exam, which was the exam in December 2017, so relatively recently. Let's start off with question one. So we've got a bit of a chart down here, so I'm starting to think it's to do with preparation of financial statements, but as usual, I'm going to skip to the end and see what question we have to do. So it's going to be a 20-mark question. So it's going to be a lot of work. Okay, so the first question is prepare all journal entries required during the year ended 30 June 2018 to account for the transactions and events identified in points 1 to 5 above. Ignore the impact of tax and show all workings. That's 13 marks. And then part B is complete the statement of changes in equity for Escape Limited for the year ended 30 June 2018. Okay, so we've got to do journal entries and we've got to do a statement of changes in equity, which is one of the different reports that we have to understand from the consolidated financial statements. Okay, so let's go back to the background information and let's read through it. So the company we're working for is Escape Limited, which create escape rooms. So the accounting team is in the process of preparing the financial statements, and we have to complete the statement of changes in equity. So we've been provided with the following template for the statement of changes in equity. Okay, that's good, so we can just fill this out ourselves. All right, so these are the issues that we need to be aware of. So number one, there's an issue of shares of 250,000 shares, ordinary shares for 500K, which brings up the ordinary issues to 2.25 million. There's a dividend of 10 cents per share on 1st of May 2018. There's an employee share scheme from July 2016. So they granted 5,000 shares to its 50 employees on condition that the employee remains in Escape's employ during the vesting period. Okay, the shares had a fair value of $2 per share at grant date. The following vesting conditions are attached to the shares. The shares will vest on June 2018 if Escape's profit after tax increases by more than 20% per year, averaged across the 2 years. And second criteria is the shares will vest on 30 June 2019 if Escape's profit after tax increases by more than 15% per year, averaged across the 3 years. By 30 June 2017, 2 employees had left the company and Escape's earning had increased by 23%. At that date, Escape's management estimated that earnings would increase by 20% in June 2018 and that a further 5 employees would leave the company during the year to 30 June 2018. In the year ended 30 June 2018, only 4 employees left the company and Escape's earnings increased by 16%. At 30 June 2018, Escape's management estimated that earnings would increase by 18% in 2019 and that a further 3 employees would leave the company. Escape uses a share-based payment reserve for equity-settled share-based payment transactions. Escape has no other equity-settled share-based transaction payments. So for that one, when we get to it, we're basically going to have to calculate each year what's the probability of each of the total shares being vesting, and then that's our closing balance. The next year we're going to have to do the same thing, minus our opening balance and so forth. All right, for the next one, investment. So on 1 March 2018, Escape purchased shares in Entertainment Limited, a company that is also involved in the physical adventure industry. The shares cost them $500,000 and Escape incurred transaction costs of $20K. Escape has elected to classify the investment at fair value through other comprehensive income under IFRS 9 financial instruments. Okay, so we're going to have to do a financial instrument journal for that one. Next is asset revaluation. So at 1 July 2017, Escape's only property consisted of a block of land in one of the suburbs of Adelaide. And during the year ended 30 June 2018, the following events occurred in relation to the property. The fair value of the Adelaide property fell from $800K to $550K. Escape acquired land in Broadbeach for $400K, and by 30 June 2018, the fair value had increased to $480K. After initial recognition, Escape values properties under the revaluation model in IS 16. Okay, so for profit, for the year ended 30 June 2018, profit has been calculated to be $420,000. So that's the final profit figure and does not require adjustments for the transactions required above. Okay, so what we have to do is prepare the journal entries and prepare the statement of changes in equity. So what I would recommend you do in terms of approach is just start off with your working. So just get your work paper open, go by one, work through each one, figure out what the journal is going to be and figure out what the impact is going to be. And then once we've finished all of them, we can figure out, okay, what do we actually have to do in terms of journals and impact on statement of changes in equity. So walking it through step by step, I know it seems a lot in aggregate, but if you break it down into separate issues, it'll make it a lot easier, I promise. So let's work through that now. Let me just bring up my work paper. and I'll just set it up so we can work through these now. Okay, so the first thing that I'd like you to do is just open up your exam Bible, which gives you all the journal templates that you need, which is, since we're doing a journals question, this should just give us the answers we need. We just got to choose the category and think critically whilst we're doing them. So the first one's to do with an issue of shares. So I'm then going to scroll down to Unit 9, Financial Instruments, and it's got our journals right there that we need. Now, granted, this is a pretty easy one to start off with. You might not need the exam Bible for this one. You can just use your knowledge of accounting to know that the journal entry for issuing capital should just be debit cash, credit share capital. Now remember, anytime we're going to do a journal entry, we need to make sure that the template has all the formatting that we need, because you can lose easy marks if you haven't formatted your question correctly. So the things we need in here, you can just copy and paste this down, is going to be debit and credit. Okay, make sure you include all of these plus a description. Okay, so these are all the things that you need. If you miss any of these, you put yourself at risk of losing easy marks. And I'd also like to do like a 1 just to reflect which question it kind of relates to. Okay, so there we go. So the date that we're going to recognize it is going to be the 1st of August. If you put that at the end of the year, you're going to probably lose a mark on this question. It's going to be 1st of August, and also don't put 17, put X7, just like it says in the question, because X could be 27, 37, and so forth. So it's going to be debit cash because they're issuing shares. So the cash is going to go up. It's an asset, should be 250,000. The credit should balance that perfectly, and that's just going to be. And now I'm going to specify ordinary share capital because it does actually say in the question ordinary shares. So we're going to go ordinary share capital. Perfect. All right. And then in brackets, I would also write equity just to make it super easy for the marker just to tick it off so you know exactly what account it relates to, and that you haven't misallocated to a debt or something like that. It's definitely equity. Okay, so that's how you do the first one. All right, let's do the second one, which is the dividend. Okay, so the date of this one, if we have a look at the question, the date's going to be 1st of May. And again, if you get the date wrong, you're not going to get a mark for this question. So you're going to pay a dividend, right? So again, we could refer to our exam Bible over here and look for dividends paid. Now the only consideration here, okay, so we're going to have a dividends paid account, which is actually an equity account, and then we're going to have a dividends payable, or it might be cash on the credit side. It really depends if they've actually paid it already or if they're going to pay it in future, which would be a payable. So generally either of those, either payable or cash, would be acceptable, but given in the question that it actually says that they're paid past tense, I'm going to put it to cash. I think that's the safer option, but I think in the exam if you put dividend payable, that would be fine as well. So it's going to be dividend paid, just literally just copying whatever it was in the exam Bible template. Dividend, I'm going to put this as cash instead of dividend payable. Okay, so it's 10 cents a share. So how many shares do we have? We've got 2.25 million shares over there. So we're going to go 0.1 times 2250, 123. It's going to be 225k. And then our description is going to be to recognize dividend payable declared. So it's going to be 2.25 times 10 cents. Okay, moving on to our employee share scheme. So it's starting to get a little bit more difficult now. Okay, so for this, what we're going to do is we're going to look at the exam Bible. We're going to scroll down to share-based payments where it's given us the formula that we need to do this. We literally just need to fill out this table, follow the formula there, and it gives us the journal that we need to post. Now, because the share-based payment journals are over time, you got to calculate from the beginning. You got to go year 1, the liability is, X amount. Year 2, with the liability is Y amount. So the expense is the difference between the closing balance of year 1 and the closing balance of year 2. So that's the expense. And then do the same for year 3. Now each year in this process, you need to do your best estimate at that point in time. So it's the number of staff that are currently employed, the number of shares at that current point in time, the likelihood it's going to vest. So it might vest in year 2, in which case you do 1/2, or it might be expected to vest in year 3, which means you do 1/3, and so forth. But everything you need to know is in this little table here. Okay, so I'm just going to put them side by side. Hopefully you can read that. So first of all, because the employee share scheme was issued in FY17, so 1 July 2016, we need to figure out what the closing balance was at FY17. And we know that the scheme is either going to be 2 years long or it's either going to be 3 years long, because if the shares, because it says here, the shares will vest in 2018, i.e. 1 year later, if the profit after tax increases by more than 20% a year, average across the 2 years. Okay, if that's the case, then the shares vest in year 2, that's it. The share scheme is done, gets paid out then. However, if they don't reach that target, then it's pushed out to year 3, and then it's averaged over 3 years. So it really depends on the company's expectations as to whether the company will meet that target as well. And the other thing we need to consider is the number of staff and which ones are expected to leave as well. See how it says number of staff expected. So it's not just the actual number of staff, they also have to consider how many staff do we think are going to leave as well. Okay, so alright, so the opening balance we know is, so the number of, okay, so I'm just following that formula up the top there. So number of staff expected. So we know that there's 50 staff to begin with. Okay. Now, how many staff have left during the year? Now I'm doing FY17, keep in mind. So we can see down the bottom that 2 employees had left the company. So I'm going to do -2. However, we're not finished yet, because it's not just, as I said before, it's not just the number of employees who have left, it's the number of employees who are expected to leave. So we've got to minus it by the expected number that are going to leave as well. So can you see that in here anywhere? Okay, there it is. Then there's that a further 5 employees would leave the company during the year 30 June 2018. So that's the expectation currently. So we also need to do -5. Okay, so that's our expected number of employees. That's the first thing. Then the next is the number of shares, which I can see is 5,000 over here. So I'm going to times that by 5,000. And then it's times the share price at the vested period. So I can see that it's $2 over there. And then the only thing I need to do is then apportion it by the vesting, by the period, or the portion of the vesting period completed. So is it 1/3 or is it a half? So it really depends on whether we think the shares are going to vest in 2018 or if they're going to vest in 2019. So let's see if they're expecting that that the profit after tax will increase by more than 20%. Okay, so it says here, by 30 June 2017, 2 employees had left the company and Escape's earnings had increased by 23%. Okay, so in reality, they're probably expecting by the end of 2018, so at the date, Escape's management estimated that earnings would increase by 20% in 2018. So if you've got 23% actual growth in 2017, the first year, and then second year we're expecting to be 20%, that means the average growth is going to be around 21-22%, which is above the minimum vesting hurdle for them to vest in year 2. So really, it's only going to vest in 2 years, not 3. So the last thing we need to do is divide by 2. Or sorry, times by 1/2. There we go. Now, the next thing is when it comes around to FY18, let's recalculate it then. So in the year ended 30 June 2018, only 4 companies left the company. So to calculate the number of employees, I'm reading from over here now, the second year, we have to calculate. So there was 50 to start with. We know that 2 left in year 1, and now in this extra information down here, we know that 4 employees have left in 2018. And then because it's not vesting in that year, because it says that the earnings are actually below that 18%, it means that the number of employees we need to factor in are going to leave next year as well. So, and it's expected that a further 3 employees would leave the company. So we're going to do minus 3. So that's now our employee number 41 that we're going to be working off. Okay, the next thing that we need to do is the number of shares. So it's still going to be 5,000. And the share price is still going to be $2. So 5,000 times 2. But the only thing that we need to do now is apportion it by the number of years left. So as I mentioned before, the new information there is that at 30 June 2018, the earnings for that year were actually 16% as opposed to the 20% forecasted. So the average of the 2 years is 23 plus 16 over 2, so it's going to be 39% divided by 2, so it's just under 20%. So it means that the shares didn't actually vest in that year. It means we're going to have to push out that 1 more year. So that's why I've gone divide by 3, or times by 2/3, I should say. So there's our liability, and the expense between the two should be the difference between those two, so the 58,333. Okay, so because we're doing journals for the year-end FY18, it means the journal entry that we need to post, I'm going to remove the color so we don't get confused there. The journal entry that we need to post at the end of the year is going to be 3006.x8. Okay, and then I'm just reading from up there. So it's going to be employee benefits expense, and then I'm going to link it into that expense amount up there, 58,333. And let's just round that as well. Employee benefits expense. And then on the other side, what the journal is going to be is it's dependent on whether it's a cash settled share-based payment or an equity settled. Now, because this one is going to be paid out of equity, so it's going to be giving them shares, not cash, we need to use this journal down here. So the other side is going to be equity. So we're going to go share-based payment reserve equity. I mean, I'm sure they'll just accept equity as well, but I'm just trying to be as specific as possible to minimize the chance that we won't lose any marks. And of course, we need this description down here to record remuneration expense relating to issue of 5,000 shares. Okay, cool. So that's part 3 done. Let's bring up our exam again. All right, so the next one is an investment in a company. 3, 4. So Escape purchased shares in Entertainment Limited, a company that is also involved in the same industry. The shares cost 500k, and Escape incurred transaction costs of 20k. And they've elected to classify the investment at fair value through other OCI. And the fair value of the instrument was 545k. All right, so we can see it's a fair value through other comprehensive income, so we know it's a financial instrument question. So what I want you to do is open up your exam Bible, go to financial instruments. There's a subcategory down here called accounting for an investment at fair value through other comprehensive income. We're going to click on that. This gives us all the journals we need. Pretty straightforward. So let me just copy the template we've got down up here. So the first thing is initial recognition. Initial recognition. And we want to recognize this at the date we bought it. So we bought this at, where is it? 1st of March. 1st of March, X18. Okay, and then in the okay, so what we need to do is we need to go investment, fair value, other comprehensive income, and then the other side is going to be cash. Let me just confirm that's right when I read the question. And it says down here to recognize initially measure the investment at fair value plus transaction cost. So we need to actually recognize it with transaction costs included. We could split them out into two separate journals, I should say, but I think it's fine to include it under the single one. So it's going to be 520,000. Credit cash is going to be the opposite. So this should be fine. Now the next thing we need to do, because that's at 1 March, we also need to do the end of year adjustment. So if we go back to our exam Bibles and read through it. Now this might be a little bit confusing because it depends on, see it says year-end accounting. Is there any interest income? There's no interest income associated with it, so there's no adjustment for that. That's only if it's an amortized cost. If it's a bond issue mid-year, we need to do this journal, but there's no bond issues. It's not applicable here. But what is applicable here is this fair value adjustment entry. So that's when there's a change in the fair value of the underlying asset. So we need to actually post this journal as well. I'll put the description in there. The other thing that we might want to do just to make this is fine, we'd probably get full marks for this, but just to make it even better, what I might put in bracket is the name of the company itself. So, which was, I think it was Entertainment Limited. Just to make it really perfect response, just in case. Okay, and then for this revaluation, so is the revaluation going up? So it's going up to 545k. So what we want to go is 545k less whatever it was before, and there's our adjustment there, the 25k. So we want the asset to go up 25k, and then the other side, if we look at the journal over there, is going to be fair value, or I should say fair value through other comprehensive income reserve. Cool. That's how we recognize that one. Okay, so moving on, number 5, asset revaluation. Okay, so they own the property already. They've got a block of land. And then during FY18, the following events occurred. So the fair value fell from 800k to 550k, and then they also acquired land on 1 September 2017 for 400k, and that the value of this property had increased to 480k. So the first thing I'm going to do is I'm going to go back to my exam Bible. I'm going to find the relevant category, so it's going to be property, plant and equipment, and then this has got our revaluation journals in here. So, and we've also been told to ignore tax, which makes it easier for us because we don't need to do these DTA, DTL, etc. expenses. So the first thing that we need to do is just recognize the purchase. So this property over here, the Adelaide property, it was already on the books already. So let's just focus on the new property first because we need to post that journal, whereas we don't need to post that recognition journal for the property that was already on the books. So okay, so this one's to do with the acquisition of land in Broadbeach. They bought it on 1st of September 2017, which is in the FY18 financial year. So I'm going to call this land Broadbeach. It's going to be 400,000, and then they pay it with cash. Yeah, we'll assume they paid it with cash, 400k. So there we go there. The other thing we need to do is actually recognize the revaluation upwards, and that would be at the end of the financial year. So we're going to go 30 June 2018, and we're going to go debit land, the revaluation amount, and then the other side, if you're not sure where the other side is going to go to, we just need to find our journal over here. So we've got our increment, no prior decrement recognized in P&L. So that's the situation we want, because we want to increase the value of the asset and we haven't previously recognized the decrement. So what we're going to do is we're going to go revaluation surplus OCI. So the increase in the property is going to be 80k. So we're going to go, because it's 400 to 480, so it's 80k difference. So it's going to 80,000. Okay, perfect. Okay, next we've got to deal with the property that was already on the books. So we've got another revaluation. So it's going from 800k to 550k. So we've got a revaluation of 250,000. Yep, 250,000. So the key issue with these kinds of questions, right? And you can see it as soon as you look at the exam Bible, is you need to figure out what the situation was before. So we need to figure out from the question whether or not there's been a prior revaluation or not, and if so, was it an increment or a decrement? Because depending on whether it was an increment or decrement, it's going to change the journals we're going to use. So once we know that, we can just choose. We can look in here and choose the relevant journals to use. So okay, so let's go back to the exam. I can see blah 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 40. So there's nothing in here that says whether or not it's had a revaluation. The only clue it tells us is that they already do use the revaluation model and that they reevaluate every year. So we know that there has been some sort of revaluation already, and we know that it does not apply the IAS 16 revaluation model to any other asset class. So what that's basically telling us is it means we can look through the question, look at what's actually already in the revaluation reserve, and because they haven't applied it to any other asset class, we know that revaluation there, the 200k, is actually applicable to this particular property. So we know that they've previously revalued the property by 200k. So if we then go back to our exam Bible, we can see that the value of the Adelaide property fell from 800k to 550k. So basically, we're recognizing the decrement, but reversing. So if you think about what happened last year, if they've got 200k sitting in the revaluation surplus, that means last year they would have increased the asset by 200k. They would have gone debit PP&E, and they would have gone credit revaluation surplus OCI, which is why we're seeing that amount in the statement of changes in equity. So what that means is increment 200k. This year you want to decrease by 250k. That means that we want to use this one down here, which is the previous revaluation increment, which was smaller than the new decrement, because the 250k is bigger than the previous 200k. So this is the journal we want to use, but the question has specified that we are going to ignore tax, so we can ignore the DTL, we can ignore the DTA, and the income tax expense. So let's post our final journal down here. Okay, so what we want to do is we're going to go, the first one's revaluation surplus. It says previous increment in brackets over there. So the previous increment was 200k, so I'm going to put that in there. The next one is DTL, so we're not doing tax for this particular question, so we can ignore that. Then we can go revaluation expense, which is the excess of the previous increment in brackets there. So it's going to be the difference between the 250 and the 200. So it's going to go 50,000, and then we can go land, and the building is called Adelaide. Yeah, Adelaide. And that's going to go down the sum of the other two, so 250,000. And the description is reversing prior increment and posting decrement. So there's our journal right there. Okay, so that's 5 done. If I scroll down, I can see that's the end of it, and that means we have completed 100% of A. So we've got 13 out of 13 by posting all of these journals over here. Okay, so the next part is we need to complete the statement of changes in equity. What I'm going to do is I'm just going to fill out this statement of changes in equity template that they've given us. And as usual, do not forget the company name up the top. Do not forget the name of the report that we're typing, so it's statement of changes in equity, and don't forget the year ended 30 June 20x18. It's a bit easier because they've actually given it to us in this question, but you know, when they just tell you to generate a certain report like a balance sheet, P&L, whatever it is, it's common to forget those titles, and then people lose a few easy marks on those ones. So next we've got issued capital, share-based payment reserve, revaluation surplus, value through other comprehensive reserve. So this is probably going to take up a fair bit of time in your exam, so maybe just practice typing it out quickly, and then, you know, hopefully save you some time when you're actually doing it in your exam. And don't forget to like bring a ruler in your pencil case as well. You know, just practice it so that when you go into the exam, it's not your first time like actually completing one, and because it's one thing to just read the question, but it's another thing to actually do it. So definitely attempt to do it a few times, and once you've done it a few times, you don't need to do it every single time. It's just to get a feel for it, and then after that, you know, it's fine to just watch videos or whatever of me doing the exam, because it's more time efficient than actually doing it yourself. Alright, we're almost done. Just give me a second. I might just pause the video and speed it up for you, and we'll be ready to go. Okay, so I filled out the table template to save you the time. So basically what I've done, I've just copied this across there, and I've included all the nuances of the formatting, including the name of the report, and the name of the company. I've carried across the opening balances. The only thing that's not listed in this table, and you can see in the table example over there, it says insert relevant lines here, is you need to be able to identify from the background information below, what the key items that are hitting OCI are. Now, we should be able to figure this out just by looking at our journals, right? What are the impacts? So we've got ordinary share capital, so that's going to be flowing through into equity. So there we go there's one. Then we've got another one down here, which is the share-based payment reserve and equity over there. What else have we got? So we've got a fair value revaluation over here of our investment at number there. And then we've got a revaluation surplus hitting OCI through over there. So this should be able to inform what you're including over here. So we've got our revaluation of PP&E, which is our land. We've got our fair value through other comprehensive income, which is our investment. Then we've got our proceeds on share issue, which was number one. Then we've got the cost of the share-based payments and the dividends paid. So in terms of how you actually allocate it between the top one, which is the top category, which is OCI, and this one, contributions by distributions to owners. Well, it's common sense if you think about what goes into distributions to owners. It's going to be dividends, it's going to be new share issues, and share-based payments, okay? Because that's like equity, if you think about it. And in the top one, it's going to be OCI. So what are the things that hit OCI? So fair value through OCI adjustments, and then a revaluation, which is hitting OCI as well. So fairly self-explanatory, but it's also in the FIN critical file as well. If you go to the financial reporting chapter and look at the template, there's some examples in there, but I'm not going to bother looking at that because it's fairly self-explanatory. Okay, so in terms of the amounts that we're actually going to put in here, so let's start off with our profit for the year. So which category do you think profit for the year is going to sit in? Is it going to be issued capital, share-based payment, revaluation surplus, fair value through other comprehensive income, or is it retained earnings? So it's always going to be in retained earnings. It's the only account that actually has anything to do with, earnings. So now we just got to look at the question and figure out what our earnings for the year is. So I can see down here it's 420K, and it does note that it's not the draft figure, it's the final profit figure. If it was the draft figure, and that you do get that in some questions, it means that you need to add some adjustments from your journal entries to get the final figure. But no, 420K is the final figure. So let's just type that in there, 420K, yep, that's all showing up. All right, the next thing is the revaluation of plant, property, and equipment. So in this case, let's scroll through our journals up here and find where that is actually sitting. So, Okay, so if I extend this one out again, the two ones that are hitting the revaluation surplus account, we know is this one here and this one here. So we've got a debit of 200K and a credit of 80K. So the difference is going to be a debit of 120K because the two net each other out. Okay, so we've done profit for the year. Revaluation of PP&E, so that's going to go into the revaluation surplus. Now, of course, a credit would be positive, and a debit would be negative because we're talking about an equity account. So we said it's going to be negative 120,000, which is the difference between that number and that number there. So there we go. Whoop, and we've got to make it negative. Just -1. Alrighty, cool. So that's that one done. The next one is fair value through other comprehensive investments. So if you remember from the question, we hit the reserve over here. It's a credit amount. So I'm just going to highlight this one. Fair value through other comprehensive income. So it's going to be 25K. Now, which account do you think it's going to be in? Is it issued capital, share-based payment, revaluation surplus, or fair value through other comprehensive income or retained earnings? Well, it's going to be this one here, fair value through other comprehensive income, because it's the same name. So we're going to add 25,000, and it's going to be a positive because it's a credit, and we're dealing with equity, which is a credit account. Alrighty, so that's everything for the other comprehensive income. So let's move on to the contributions by and distributions to owners. So the first one's going to be the proceeds on the share sale. So let's have a look in our journals up here. So where is our ordinary capital? So you can see over here 250,000. Oh, I just realized we made a mistake. This is why it's very important to check your own work when after you finish the question. Just go back and check everything is correct against the question, because you could have made a simple mistake, especially under the time pressure of an exam. So what I've done here is I've actually said 250K on the share capital issue. I've linked that to the number of shares, not the dollar amount. So it needs to be the dollar amount. So this should actually be 500,000. Apologies for any inconvenience there, but it's a good lesson because mistakes are pretty common, especially when you're moving quickly, when you're under pressure. So it's really important that you take your time, you check everything, and most importantly, once you've finished everything, allow a time buffer for you to go back and cross-reference the numbers that you're pulling. Because chances are there's going to be a mistake in there somewhere. So apologies for that. And then in terms of where that should be going, so issued capital, that should be that one there. And is it going to be a debit or a credit? So it's going to be credit to the equity, so it's going to be positive 500K. Okay, so moving on. So cost of share-based payments. So that's obviously going to relate to this question up here. When we issued an adjustment to the share-based payment reserve of 58,333, and that's going to be a credit account as well, and that's going to link to share-based reserve category. So let's just link that in there, 58,333. There we go. And then finally, dividends paid. So let's see where the journal for that one is. So we can see up here, so that's going to be a dividend paid account, which is an equity account, and it's a debit, so we're going to have a negative over here, and that's going to fall in. Do you want to guess which one it is? Is it issued capital or is it retained earnings? It's going to be retained earnings because when you pay a dividend, you're paying it out of your earnings generated by the business, going back to the shareholder, so it goes into that one there. So it's going to be negative 225, and there we have it. So all we have to do now is just make sure this is all adding up correctly. My totals are missing down the bottom. Okay, and then I'm just going to add in the formula down the bottom there as well. And make sure everything is adding up properly. You might want to, if you have time, just do an adds check, make sure everything's summing up. You're not missing any numbers in here. Okay, cool. And that's basically it. That's how you get 20 out of 20 for question 1. Again, hopefully you have some time, because this is going to be quite time consuming to pull this all together. But there's a lot of numbers in here that you need to check. So this is quite easy to do with Excel, because I could, just quickly sum them all up. But when you're in your exam, you're going to be doing manual calculator. It's going to be quite slow. So it's going to be really important to manage your time for a question like this. Okay, that's the end of question 1.